Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by Market 5. I'm your co-host, Joel Alconen, along with Dennis Dick, and we have J.C. Parets on the line. He's a chartered market technician and the founder of Eagle Bay Capital. J.C., how you doing this morning?
I'm doing well, guys. How are you?
We're doing good here. What a topsy-turvy week. When we had you on, last Thursday, market was still pretty much hanging at the upper end of its trading range, right around, 2,100. And we had some greasiness on Sunday night, kind of expanded, the lower end of the trading range. That was a really peculiar move on Sunday, and we've kind of just battled our way back. I was still in the trading range here, or are we setting up for a blast off once we get this Greek thing behind us to new all-time highs?
You know, we do this every Thursday. We talk about the ranges in the market, and I mean, we're still in a range. I mean, there's no question about it. I mean, it's as clean as it gets. Sorry about that, guys. It's really as clean as it gets. You know, you look at the S&P 500, you look at the Dow Jones Industrial Average. I mean, they're a little bit messy. I think the clean one that we want to watch is the Nasdaq 100. To me, that has the cleanest overhead supply, and if we really are going to get another leg higher in the market, that clean level, if you look at the triple Qs right above 111, if we take that out, then we can be off to the races across the board. In terms of S&P and the Dow, it's not as clean. So, the correlations are through the roof. So that's the one that I keep an eye on, and, we're towards the lower end, middle of the range overall. So, again, in the averages, still in no man's land.
What about individual stocks here? And we've been talking about Tesla just briefly there because they had some news this morning that's driving the price up $10 more. It's only $10 off its all-time high, JC, which was set back there. If we go to the weeklies, you can see that it was set back in September of 2014 when we got up to 291.42. What are your thoughts on Tesla? Can we attack that all-time high, or is that going to pose significant resistance for us?
We might. Personally, it's not something that I would touch. With that flat 200-day moving average, I mean, it's got, these things have failure written all over it. I've seen this story way too many times. I'm not saying that it can't go higher. It's just not something that I would buy, because the probability of it continuing higher is much less than the probability, in my opinion and experience, of it reverting back to the mean and heading back under 230, which, looking at it, I think is probably the higher probability outcome here is that we come down. I wouldn't short it. I don't see any reason to short it, but it's just not something I would buy. It's just it's not for me. I mean, I hope it keeps going. For the lawns, I hope everybody makes money off of it. It's just I won't be one of them.
I was making a point here just before you got on the show, and I'm not sure if you agree with this or not, but it seems like all of these momos eventually become no-nos, but eventually they become momos again. Do you just look at these things and say, when these things pull back like to their 200 days, eventually, that they're probably going to become back into favor? I mean, we saw it obviously with Netflix. We even saw it with Apple back in the day. We just saw it with Tesla here. What are your thoughts here on, obviously just buying the pullbacks when they pull back 20-30% off the highs on these Momo stocks?
It depends on whether or not there's a level that I could trade off of. So there's no fixed rule and say, okay, if it pulls back to the 200-day, I'm going to buy it, or if it pulls back 20%, I'm going to buy it. There's no hard and fixed rule. It just doesn't exist. So it's more of a setup in terms of, if and when it does pull back, like what exactly is the setup? Is there a risk reward that is skewed in our favor? If you want to look at Apple, for example, go back in Apple and go back to early 2013. You had a bullish divergence on the weekly time frame where, you had that double bottom in Apple in the first half of 2013, and soon you were putting in much, much higher lows in terms of momentum, and you had a good risk versus reward. You had the 200-week moving average and a bullish divergence. So you could have gotten in and, split adjusted, as long as it held 55, you could have owned it the whole time, no problem. Again, also more recently in terms of Apple, we were looking for a breakout above that 119, 120 level post the adjustment. And we said if we break above that, we only want to be long above the November highs from last year. And sure enough, we got a rip up towards 129, which was our target. So it's mostly if the risk is well defined. So you look at a name like Tesla right now, and the question that we want to ask ourselves is, okay, let's say we buy it right here at 280, whatever it's trading pre-market. Where am I wrong? At what point? Where do I set a stop? At what point can I say, okay, all bets are off? I'm wrong on this. The problem with this chart, for me personally, is that I can't define that level. I can't tell you, at this point I'm wrong, at this point I'm right. It's not there for me. In fact, to the contrary, you're looking at 280. Let's say we start getting up towards 290 and start retesting those highs. If I wanted to short it, I could potentially say, okay, if we take out the highs from September, all bets are off. Now, I'm not saying that's what I'm going to do, but at least there's a level that I could trade against potentially, if for whatever reason I wanted to be short. See what I'm saying? So that's more important to me than anything else.
No, you just you're very consistent with what you talk. You always talk about the risk reward, and right, you're buying it here. What are you gonna do? Chances are, if you think it's going all time highs, you buy it at 280. You try and go 275 stop to get the 290 print. I mean, there's a pretty good chance they could take this thing down to 275, nick you, and then go right back up. So also trading.
Number one, yes. Number one, you're absolutely right. Number two, that's only a 2-to-1 risk.
Yeah, that's not even good enough.
Reward to risk ratio. That's a terrible skew. I mean, 2-to-1. I mean, for that, why even bother? We want risk-reward ratios that are north of 6, 8, 10 to 1. That's what we're looking for, not basically, which is essentially what this is. So yeah, and there's nothing like where am I going to put a stop? I'd just be making up a random level.
Yeah, and they'll get you. They'll get you every time.
Is that? I want to stop at that point. Is that your normal risk return ratio? Because that's higher than like what I've normally heard from traders. Like I'm in the prop industry for 15 years here now, and I've always went 2 or 3 to 1, 6, 8 to 1, 10 to 1 risk return ratios. Those are incredible. Is that what you're normally entering a trade for? Is a 6 or 8 to 1 risk return ratio, JC?
I wish I could tell you that was the case every time, but obviously, those are few and far between. But yeah, you get them totally. In a lot of those cases where the reward to risk ratio is much higher, the probability might not necessarily be in your favor, like something with a lower reward to risk ratio might be. So that there's the probability aspect to it as well. That you want to take it into account. And, So, for example, bonds is something that we like against the June lows. We're really close to those levels. We got down close to those levels, this morning. So we're the risk.
What stock was that, JC?
Here, I think is skewed
TLT,
favorable.
right? TLT, is that what you took? Can we go basis to TLT here on that? I know.
Sure. I think there's too much risk to be in the TLT because it doesn't open up until 9:30. So I think you're better off in the futures,
bonds?
much better off in the futures because it's easier to define, define the risk. Because what happens overnight, something happens and bonds are getting destroyed. What are you going to do? You're stuck in this thing till 9:30 or whenever it starts trading pre-market. So I find it to be a huge disadvantage to trade the TLT. Not to mention you don't get the leverage that you're getting in the ZB, so it's much more expensive. You're better off in the futures.
And what's the 200 moving? Do you have the 200-day moving average in the bond and the TLT? Because a buddy of mine was looking at it and got some really good trades out. Do you have that? Do you have that in front of you?
Yeah, I'm looking at 124 and a quarter. That's actually the target. That's where I think it's going.
Okay.
If we're wrong on this trade, hey, we're wrong. We move on, find another day. But I think that's where we're headed. I totally do. I think we take out the highs from Sunday night and. We're heading off to 124, 125. 124 and change. I think that's where we're headed. So hopefully I'm right.
No, and I think also another point when you were talking about your risk-reward ratios, you start out, with a stop in, whatever it's based on, but the trades that you're in, they end up being 6, 7, 8 because if they start going your way, then you expand your horizon, you get better targets. Whereas if if you're wrong and you get out, I mean that's the way you need to trade to try and let the winners go. Just gonna throw
number one and number two, I'll also add to positions. Once I'm proven right, like you never want to buy. You never want to put good money after bad money, right? You don't want to average down, right? Losers average down losers, as they say. So you want to be putting good money after good. and adding to winning positions. And then sometimes what we'll do is, we'll nail, get lucky with the entry, and we nail the trade right off the bat. Sometimes we'll take profits on the common and then just roll just the profits into premium and buy call options or something like that with just the profits that we made in the common. So at that point, it's a risk-free trade. If it winds up rolling over, whatever the case may be, we just lose the profits that we originally made. So I'll do stuff like that also, where you'll essentially get exponential returns just because you're putting up based on the profits that you originally had.
JC, I want to get your thoughts on one of the most widely owned stocks out there, and it's AT&T. And this thing has been catching upgrades left and right over the last couple of weeks. It's got another upgrade here this morning. Cowen and Company is upgrading the stock. They're raising their price target from 35 to 40. You also have Buckingham Research coincidentally initiating with a buy with a price target of 41. AT&T historically doesn't move much there, and I know we're coming towards the upper end of this range here. Are you trading AT&T? Do you trade AT&T at all? And what are your thoughts here on this one?
AT&T is one that I look at, and let's just sit and have a cumulative laugh here, and how hilarious it is when a stock gets kicked out of the Dow, how well it does. I mean, this is just another example. Isn't it hilarious?
That's a good point, actually. I never
When did
thought
it get
about
kicked
that.
out?
I mean, we've seen this so many times. You saw it with Alcoa when they kicked it out of that. I mean, we could go back and talk about a lot of examples, but I think it's hysterical. It's got a nice dividend. It's like you said, it doesn't do much, hasn't done much. You're going to throw Verizon in there as well. Throw the IYZ, which is the telecom ETF, which is basically AT&T and Verizon, and then a few others. I'd rather look at the strength here in AT&T and see that flight to higher dividend names and kind of throw that in the camp that perhaps my thesis of lower interest rates is correct, and that's why we're seeing money flowing into AT&T. As money searches for that yield in the quote unquote boring stock. So I think it's really interesting. Gets kicked out of the Dow, just starts ripping right away. Really nice dividend. What are they paying? 6% or something absurd like that? 5%?
JC, before we let you go here, we only got a couple minutes left. Just want you to get your take on the transportation index, and have a couple firms stepping out yesterday. They came up with a recommendation on Love, Southwest Airlines, and then the government comes out and says they're going to be investigating collusion here. Pretty broken chart here. Is there any reason for investors to start taking a look at some of these airlines?
The transportation index, to answer your first question,
yep.
The transportation index, we had key support all through June, right around that 82.50 level, 82.60, and that broke. Lower lows, lower highs. The 200-day moving average is rolling over. That support that had held throughout June was a 61.8% Fibonacci retracement of the October to November rally. So that was a big key level, and that broke. I think that's going to be overhead supply for now. If we can get back above that, then maybe we'll see 8,500 or something like that. Not something I'd be trading. Looking at the airline index, look at XAL, which is the Amex Airline Index. That's a tough one to be buying. Again, broken all of that support, tried to get back above and failed. That's messy. Ultimately, we don't have any bullish momentum divergences at all. I'd be surprised if we didn't see lower lows. Now, in the XAL, in terms of the airlines, getting back to your point on the Love and things like that, look at XAL, and there's huge resistance around 88.5 in the second half of last year. It's very, very clean resistance, and we broke above that right after Halloween, or on Halloween, actually. And on any sell-off, I think that should be support. So I would be looking to be a tactical buyer of airlines when XAL gets anywhere between 86 to 88.5. In that range, that's where I would be looking to put new money to work. If we keep crashing below that, I wouldn't want anything to do with it. But just off the cuff, I'd certainly be setting some alerts down there and be looking to put risk on if we get there.
We've been on the line with JC Parets. He's the founder of Eagle Bay Capital. He joins us every Thursday at 8:35 to talk about his money management strategies and technical analysis. He likes to throw in a little behavioral finance into his analysis. JC, have a safe 4th of July. We'll talk to you next Thursday.
Thanks a lot, guys. Have a good weekend.
See you, JC.